Okay, let's unpack this. We are diving into a deep value puzzle today. One where, well, the reward side of the equation is projected to be absolutely massive.
It really is.
We're digging into the latest analysis reports covering STMicroelectronics, ticker symbol STM.
And we're talking about figures that really demand your attention. I mean, high-level analysis reports are projecting a potential return of 50%, with some models stretching that upside target even toward 90%.
That's a huge number, and this is for a stock that's been struggling, right? It's currently trading just under $29.
Yeah, around $28.84 as of this morning.
So that's the number that grabbed us. You have a stock at about $28.84, yet the consensus target prices analysts are putting out there, they range from $45 all the way up to $55.
A huge disconnect.
So our mission today is pretty straightforward. We need to understand how the top analysts justify a forecast this dramatic for a company that, honestly, a lot of people are pretty skeptical about right now.
Well, the central tension here is a classic market misalignment.
Misalignment how?
Right now, the market is overwhelmingly focused on the rearview mirror.
The bad stuff.
Exactly. The bad earnings, the really painful inventory correction, all the cyclical troubles that plagued the entire chip sector last year. But the analysis we've been digging into suggests that focusing on 2024 is, well, it's missing the plot entirely.
Okay, so where is the plot?
The real story and the justification for those high target prices lies in the future, specifically in a forward-looking supercycle that's projected for 2026.
A super cycle.
Yeah, and it's built on three interlocking pieces: a major cyclical recovery, a massive shift in manufacturing efficiency, and STM's sort of a quiet dominance in the electric vehicle supply chain.
Okay, let's start with the immediate red flag, because you can't look at this stock without asking the big question about valuation.
The PE ratio.
Yeah, the trailing PE ratio. That standard metric everyone looks at is sitting well over 50. In any historical context, that just screams expensive. So how can anyone argue for 50% upside on a stock that, on paper, looks overvalued right now? That feels like a contradiction.
It is a contradiction. But that contradiction is precisely where the opportunity is. That PE of 50.30 is high, right, but not because the price is inflated. It's high because the earnings are artificially depressed.
Ah, so the denominator in the equation just cratered last year.
Precisely. The earnings base in that trailing PE calculation is from a disastrous temporary low point. It was caused by that one-time cyclical downturn in inventory glut.
Okay.
It's like valuing a coffee shop based on its revenue during the 3 months it was closed for renovations. The number is just totally distorted because it's looking backward at a period of acute temporary pain.
So if we're told not to look in the rearview mirror, where should we be looking? What does the real valuation look like?
The analysis is insistent on this point. You have to look at the forward PE.
Using future earnings estimates.
Exactly. Using the much higher normalized earnings estimates projected out toward 2027. And when you factor in the massive recovery and the efficiency gains we're about to get into, the whole valuation picture flips. It goes from expensive to, frankly, deep value.
So what multiple are we actually buying this recovery story at then?
Based on those 2027 estimates, which are aggressive but seem achievable, STM is trading closer to a very conservative 12x to 15x PE multiple.
Okay, that's a much more reasonable number.
It's more than reasonable. Now, put that number next to its closest competitors in automotive and industrial chips.
Yeah.
Companies like NXP Semiconductors or Infineon. STM looks significantly cheaper.
I see.
The core insight here is that you are essentially getting high-growth exposure to these critical future technologies like EVs and industrial automation, but you're buying it today at a price multiple usually reserved for like a slow-growth, mature value stock.
Okay, that solves the valuation mystery for me. So let's pivot to that forward confidence. A forward PE is only as good as the earnings fueling it. What are the three biggest drivers that analysts think will fundamentally change STM's profitability starting in 2026?
Right, and these three are projected to hit at basically the same time in that 2026-2027 window. That's what creates the supercycle.
So where do we start?
Let's start with the most foundational one. Just getting customers to actually place orders again.
Catalyst number one. The inventory reset is finally complete.
Exactly. Remember the problem. For the last, say, 18 months, STM's biggest clients in industrial and automotive.
Companies like Tesla, BMW, Apple.
Yeah, enormous customers for them. They all basically hit the brakes on ordering. They were sitting on these huge stockpiles of chips from the COVID-era supply crunch.
So they were just working through their inventory.
Right, and that correction phase was necessary, but it was painful for STM. The analysis now signals that this correction is officially over.
And what's the hard evidence for that? How do we know Q1 2026 is the bottom?
Well, the CEO, Jean-Marc Chery, has been pretty clear in his communications, which the analysis reflects. He's saying the channel inventories is largely normalized, and the implication is crucial.
Which is?
Those massive customers have finally run down their old stock. They're now at a point where just to maintain production for 2026 and beyond, they have no choice but to start reordering in bulk.
So we're moving from a period of no demand to a mandatory restocking cycle.
A mandatory restocking cycle that analysts expect to accelerate sharply through 2026. So Catalyst 1 is pure volume growth, a demand shock.
A volume shock wave. Okay.
Yeah.
That takes care of the top line. But the second catalyst you mentioned, the 300 millimeter margin explosion, that sounds like it's all about profit.
This might be the most powerful and least understood part of the entire thesis. It's where physics and economics just converge perfectly.
Explain that.
So STM has spent billions capital expenditure that really depressed their earnings for the past few years, building these cutting-edge factories. And these factories use 300 millimeter silicon wafers instead of the industry's older 200 millimeter standard.
And why does that 100 millimeter difference matter so much to the bottom line?
It's just geometry. A 300 millimeter wafer has 2.25 times the surface area of a 200 millimeter one.
Wow, okay.
Now think about the economics of that. You're using roughly the same amount of labor, the same clean room space, the same processing time, but you're getting over twice the number of actual chips from a single wafer. That translates directly into a massive step function reduction in your cost per unit.
So while they were building these new facilities, the balance sheet just saw pure expense.
Exactly. It was a massive drag. But the analysis is pointing out that 2025 and 2026 are the pivot years. This is when these state-of-the-art facilities shift from being construction costs to being profit centers, fully running at scale.
And that pivot creates what the analysts are calling the depreciation tailwind. Can you make that intuitive for us?
Absolutely. Think of it like paying off a gigantic mortgage on a huge apartment building. For years, your massive capital investment, that's the depreciation, was a huge expense, eating into your cash flow and your declared earnings.
Right.
But once that investment is basically sunk and the factory is fully operational, all that spending suddenly starts paying you back by producing chips at drastically lower costs. The fixed costs stay the same, but the output and efficiency just explode.
So margins go up?
Margins are expected to expand significantly, and this is key, independent of what the price of the chips is. It's a structural improvement.
That is a phenomenal combination. So you have accelerating volume from the inventory reset, and you have massive margin expansion from this depreciation tailwind.
You got it.
Okay, let's move to catalyst number 3, which connects all this new efficiency directly to the biggest growth driver in the industry. Silicon carbide or SiC.
Right, and STM is positioned as a foundational global leader in 6 chips. These are specialized semiconductors that are absolutely critical for power electronics and EVs.
Why EVs specifically?
Because they're just vastly superior at handling high voltage, high efficiency power management compared to traditional silicon. They're essential for things like inverters.
I know a lot of our listeners are probably skeptical right now. We hear about the EV slowdown constantly in the media. Doesn't that risk undermining the whole C6C thesis?
That's a great question, and the analysis addresses it head on. It distinguishes between the immediate adoption rate and the strategic partnerships.
Okay.
So yes, there is short-term volatility in mass market EV adoption, no one denies that. However, the long-term strategic shift to electrification is locked in. And critically, STM's focus is on the high-margin, high-performance segment of the market.
Where their product makes the biggest difference.
Precisely. Their C-SKI chips are essential for maximum range and performance, which is why they have a deep, crucial supply relationship with major players, including a big one with Tesla.
I see.
So the analysis argues that even if the overall EV ramp-up is a bit slower than people first hoped, STM's dominance in this specific high-margin niche guarantees a robust rebound in their CC revenue as the ED market normalizes and accelerates again in 2026.
So if we put it all together, volume, margin, and that specialized demand, it paints a really compelling picture of a company moving from a cost phase to a massive profit cycle. But let's talk credibility. Are these targets $45 to $55? Are they consensus or are they outliers?
No, they are strong consensus, which really speaks to the confidence in these future efficiencies. We see concrete data points. For instance, Baird just upgraded STM. They set a $45 target, and they specifically pointed to the gross margin recovery driven by those 300 millimeter facilities ramping up.
So they see that depreciation tailwind as a guaranteed profit injection.
That's exactly how they framed it.
And what about the high end of that forecast, the $55 number?
Well, firms like Susquehanna have maintained targets as high as $55 in their broader semiconductor cycle analyses. The overall consensus is powerful. The stock is currently priced for the pain of the past. It has fully washed out all the bad news.
And it's positioned for a reversal.
A reversal based on these future catalysts. The market, it seems, has simply not yet priced in the sheer scale of the 300 millimeter efficiency gain.
To give you some context on why analysts feel the technical setup confirms this thesis, let's look at the recent trading activity. This stock has been all over the place.
Oh, it has been through a serious washout. The stock hit a multi-year low recently, dropping all the way down to $17.25.
Wow, $17. That level shows just how much fear and really capitulation was priced in during that inventory correction.
Total capitulation.
That's a serious discount and a good measuring stick for the risk that was perceived. So what does the recovery look like so far?
What's compelling is the sheer velocity of the rebound. The stock has already rocketed about 65% off those lows to get back to where it is now, around $28.
That's a huge bounce.
And that sharp ascent confirms the analysis's view that a classic V-shaped recovery, a sharp drop followed by an aggressive rebound, is actively underway. The fear has peaked. The money is starting to flow back in, anticipated these 2026 catalysts.
So for those looking to chart this path, what are the immediate technical levels to watch for a major breakout, according to the reports?
The immediate breakout level is the $30 mark. If STM can break convincingly above $30 and do it with strong volume, the technical analysis suggests there's very little resistance until it hits the $38 to $40 range.
And that would be the first major leg up toward those analyst targets.
The first major leg up.
What if there's, short-term turbulence, the market sells off the whole sector? Where's the floor for someone looking to build a long-term position?
The analysis identifies the range of $24 to $25 as the golden buy zone.
The golden buy zone.
Yeah, that zone provides strong technical support while still offering, maximum upside potential towards those consensus targets.
So let's bring this full circle. We've talked about a deep volume cycle, a margin explosion, specialized product demand. What is the overarching narrative that ties this whole deep dive together?
The narrative is classic deep value. STMicroelectronics is the quintessential ugly duckling play. The chart still looks messy. The backward-looking trailing PE suggests it's too expensive.
Yeah.
But that messiness, that temporary fear, is exactly the smokescreen that's concealing the actual value here.
So you're saying you are buying into the future recovery of both the EV and the broader industrial chip cycle.
Yeah.
Powered by a massive internal efficiency upgrade, all while the market is still fixated on last year's temporary pain.
And that leads us directly to the risk-to-reward calculation. With analysts seeing a clear path to $45 and credible targets reaching $55, the analysis concludes that the downside risk, relative to that potential upside, makes this one of the most attractive risk-to-reward profiles you can find right now.
Across the entire semiconductor landscape.
Across the entire landscape.
A very compelling case built entirely on timing and, I guess, the inevitability of these complex industrial transitions.
And this deep dive really highlights a critical concept for investing. It shows how massive capital-intensive transitions, like this monumental multi-billion-dollar shift to 300mm wafer production, can be completely obscured by short-term cyclical dips like the inventory correction we just saw.
Right.
So this raises an important question for you to consider moving forward. What other industrial or technology companies out there might be hiding a massive, efficiency-driven margin explosion just around the corner, one that's currently masked by similar short-term inventory woes or cyclical market noise? Because finding that hidden pivot, that's often the key to true deep value investing.